All right, I've been on the road for about 2 weeks now, whereas I rarely leave my dungeon normally. So I'm operating on a few hours of sleep and a little more than a few liters of coffee. So you're have to forgive me, I'm gonna be a little more annoying than I usually am. For those of you who have the pleasure of not knowing me, my name's Antonio. I run I don't really know what it is, but some call it a research platform or a YouTube channel and a website. We do deep dives into companies. It's called Resource Talks on YouTube, or resourcetalks.com is where you can find everything. And today we're talking about, something that's near and dear to my heart. Uranium is a thing actually that brought me into this wonderfully awful space of junior mining back in 2018. And we have Fabi Lara, that's the tall blonde guy over. Oh no, wait. Is it the other way around? Yeah, so Fabi Lara of the Next Big Rush. And of course, Mart Wolbert. He's got a couple of names. So Yellow Bull on Twitter, Contrarian Codex on Patreon, and Mart Wolbert for the buddies. I know we're supposed to go ladies first, but I'm a peasant with no manners.
I don't mind.
So Mart, I want to kick it off with you. Go ahead. Again, I've been on the road for a couple of weeks now. What's going on with uranium? What's been happening most recently? Are we still en route to $500, or should I cancel my pre-ordered Lambo?
Well, it's certainly been a very interesting few years for uranium, but given that you asked the question for more recently, it has been volatile to say the least. Of course, the most recent news that a lot of you may have seen was the Russian export ban of uranium, as of course a way to retaliate to the US import ban of Russian enriched uranium. And that has caused quite a reaction in the market. But right now, with the uranium thesis being as strong as it is, we don't really need any of these experts or these import bans that we've seen, because what it simply comes down to when it comes to uranium is contracting. The term market, even though a lot of people are very focused on the spot market, the term market is 75 to 80% of the volumes that are going through the physical market activity. And what you're seeing is that most of those volumes go into long-term contracts. For those of you who are not very familiar with the uranium space, so what we've seen so far this year is around 90 million pounds being signed into long-term contracts. And what that comes down to is a very, very strong rise of the term price this year to the tune of around 17 to 18% on relatively minimal volume. And that all wouldn't really matter. We wouldn't be talking about uranium right now if there wasn't a massive supply-demand deficit. So we are dealing with a demand side that is consuming 190 million pounds a year and a supply side that is failing to match that. And we have seen around 30 to 50 million pounds of annual deficits running through pretty much as far as the eye can see. So the thesis is still very strong, and I would say that right now we are at a spot where a lot of term contracting is going to be taking place over the next few years to these utilities that are the primary consumer of these pounds of uranium. Basically, what we have seen is that they have been delaying contracting over the past few years. Even despite the delaying of the contracting, we've seen the price go up substantially. So what we're seeing right now is these utilities have been delaying contracting via the importing of Chinese EOP, via the pulling forward of Russian enriched uranium, via the drawing down of inventories, and also very important via the flexing up of legacy contracts that they've signed before. But those levers, as I like to call them, they've been pulling those levers all they can over the past few years, but those are running out right now, which means that next year, I would wager that we will see the first year of replacement rate contracting, and from a historical perspective, that is when the majority of the upward price discovery will happen for uranium. That was a very long answer. I'm sorry if it bored any of you, but the setup right now is the strongest it has been in, quite frankly, decades.
I think you put Fabi's baby to sleep, so...
Always works.
Fabi, what are you seeing? You just had a kid, so I don't know how much attention you're paying to uranium, or how are you balancing out at the same time? It seems like you have good help.
I think baby or no baby, it's very difficult to keep track when the nuclear sector has delivered in the last 18 months probably something new and exciting every week, I want to say, in the last year or so at least. So yeah, I've been very much in the loop. We haven't even mentioned AI data centers, which is a new demand that I think people should take a look at, not just because we're going into this new era of AI-powered everything that you're going to see more and more, but also we're going to see, and we're actually already seeing, this was kind of the big news for the investing community in uranium, that tech players are coming in and they have to secure their own energy supply. So all of a sudden, we have been for years talking about utility buyers, and utilities as an industry, let's call it, they are broke compared to the big tech players. Meta, Google, you name it. They're all going very heavy into nuclear energy generation, and they don't care what they need to pay because the cost of running a power plant, as we know it, is very small compared to what you actually get and compared to the rest of your cost, be it CapEx or actually OpEx. And so what we may see, especially, and I'm very biased, being on the board of a US-based company, is that all of these US-based data centers are going to bring about as well purchasers that are completely different to what we've seen before. And on the supply side, we hear news after news of companies big and small not hitting their own targets. This has been a very recurrent theme. You can put them all on a dartboard and throw a dart, you're going to hit a company that hasn't really hit their targets. So we're talking Kazatomprom, they supply what, 40+% of the worldwide supply of nuclear fuel or uranium. They're not being able to really increase their supply very much. Cameco, not really interested in pushing the pedal to the metal when it comes to uranium. They are making investments down cycle in the nuclear I guess, cycle itself. And then you see small players as well. You see Paladin not being able to ramp up as they thought they would. You see Encore Energy coming out and say, actually, yeah, we're not being able to produce as much. And it's one after the other. So supply very much still restrained. And we have new demand coming in. So it's very exciting, at least from the commodity perspective. The equities is a different conversation altogether.
Exactly, and it has been, fundamentally, it has looked exciting for, again, since I've gotten in, since 2018. Replacement rate contracting specifically, something that's been discussed a lot. Maybe you can just kind of high level explain what it is, but more importantly, why do you think 2025 is the year where we see those, 180 million pounds being contracted or something along those lines?
Replacement rate contracting is basically when you look at the primary demand, which is right now at around 158 to 190 million pounds, growing at 3 to 5% a year. So for everybody in this room and outside of it listening to this back, thinking that nuclear power is a dead industry, it is not. It has firmly become a growth industry over the past few years, which is a remarkable turnaround given where it was just a decade ago. But what we're seeing right now is replacement rate contracting would be that all the primary demand, so 100% of primary demand would be covered into the future. So a bit of a history lesson. In the previous bull market where uranium price went absolutely parabolic, what we saw in the 10 to 12 years prior was that on average 31% of replacement rate contracting was being signed into long-term contracts. After that, you had 3 to 4 years of 110 to 120% of replacement rate contracting. What happened to price? It went way up. It went parabolic even. What have we seen after Fukushima from 2012 onwards? We have seen the exact same thing happen. We've seen 31 to 34% on average being contracted as a percentage of replacement rate contracting. And what are we seeing right now? We're seeing that pick up. Again, last year we were stalled at, I believe it was around 161.5 million pounds. Now that may seem like we are getting very, very close to replacement rate contracting, but 67.3 million pounds of that was between one deal between Cameco and Ukraine. And it was split up between most of their fleet and the Zaporizhzhia nuclear power plants. It's a lot of details I'm not going to get into right now. But it was a massive deal that really skewed the numbers to the upside. This year we're at, as I just mentioned, 90 million pounds. And from a historical perspective, that means that next year, and given that all these utilities that have been pulling these levers, trying to delay contracting, because for those of you who've never spoken to a fuel buyer before, these are potentially the most risk-averse people you've ever met in your life. So if they see a lot of price volatility after a year of prices going down and enough secondary supply being available, they have kind of stepped out of the market because the price went up a lot over the past year, over the past 2 years, over the past 3 years. Basically, what you're seeing right now is they're slowly but surely stepping back into the market after having reassessed it this year. And all these levers have bought them time. Those levers are running out as we speak. So next year, both from a historical perspective as well as given prevailing circumstances, you are looking at 2025 as likely being the first year of replacement rate contracting since the start of the last bull market. And again, I couldn't be more excited again. I am very biased, but I spent just as much time on the bear case as I do on the bull case. And try as I might, I've not really found a reason to sell out just yet. So I think that the most exciting part is still to come, because we have, to steal a quote from a friend and a very good contact of mine, Grant Isaac from Cameco, who very rightly put it as, we have never started a replacement rate contracting cycle at the high price point that we are at right now. And something that I would add as well, and then I promise I will stop talking, is that you will see an inventory restocking cycle on top of it. So US utilities usually hold at least 2 years worth of a fuel cycle inventory. European utilities hold around 3 years. Japanese utilities hold around 5 or more. So what you're seeing is that they have been drawing down inventories a lot over the past few years. And in the light of energy security, given that all these nuclear power plants are being enormously de-risked due to what Fabi said as well regarding data centers and tech giants wanting to pay a fat premium for their electricity, what we're seeing right now is that I think they're going to take a leaf out of the Japanese playbook. They're going to say, okay, we're not going to play with these broken supply chains, and we're not going to be trying to play chicken with producers that are not meeting their targets. We're going to go for higher inventory levels. And I think that on top of a replacement rate contracting cycle is going to send uranium prices a lot higher next year.
And just to clarify, and you are easy to look at, but we only have you here to talk, so you should not stop talking, hopefully. Fabi, what do you pay most attention to, though? Spot or term market? Spot is easy to follow. Term is really what matters in the grand scheme of things over the long run. What do you pay most attention to?
Well, what I pay most attention to is not what I recommend most people pay most attention to. So I pay attention to spot because my thesis is that I have enough time and passion for this market that I want to play in the tiny little companies. And in order to play in the smallest of companies, you have to understand retail psychology. So retail players, you and I, buying up stock because we think it's going to go somewhere. That is a different game to looking just at the commodity price. And so I think that what most people should do is to look at contracting, just like Marty mentioned here. Contracting is really where it's at, and you can see it very clearly. We reached the low years ago, and now contracting is still going up quite solidly. With the spot market, it's more reactive. It's kind of like the top-up portion of the market, and you can see numbers go up, numbers go down, and they've been kind of flat, you know, in the last couple of months, I want to say. The reason why I look at the spot market is because I own companies where the next people buying up the stock are retail buyers, and so they are looking at the spot market because it's the numbers that go up and down faster. It's a lot harder for us to have access to contract pricing, to term pricing, because it's really two guys sitting across a desk, you know, maybe during WNA that week or, you know, whenever, and they're negotiating, right? And they're negotiating a lot more than just the price. When it comes to nuclear fuel, you really want to get security down pat. So price is just one of, you know, the different items that they're negotiating. And then how do we find out what the negotiated price of each individual contract is at the end of the day? Well, you have, you know, these companies that call up both parties and ask, you know, what was the contract like? Can you give me an idea of price? Can you give me the exact price? And then they have options. They can give them the price or not give them the price or give them the wrong price. Let's be honest. And then you can buy those reports for thousands of dollars, and then you can trace the price and see, okay, this is going up, this is going down, et cetera. It's not really feasible for the everyday retail investor to do that. And so that's why I look at the spot price, and I take that as a measurement of market sentiment, and I use that, you know, to decide what to buy in the smallest of companies that I believe have a strong jurisdiction and a good story, a good team behind them.
Paying thousands of dollars for anything is not easy for any retail investor who's been in uranium since 2022, to be fair. That sounds a little bit more like a greater full game, though, here, where you say, I'm looking at the spot price because that's what's going to attract retail. That's going to be my exiting liquidity, if you want to be blunt about it. But why should I even bother with uranium explorers or uranium developers? If the thesis is that strong, as Mart presented earlier, why do I take on counterparty risk if spot is already giving me virtually no counterparty risk on the physical thing that I don't ever have to touch?
I think most people shouldn't. I think most people should concentrate on the commodity. If they believe the thesis of the commodity, then buy the commodity. I can make the same argument for gold and for silver as well. We have seen, and we have our own portfolio of uranium, but we also own silver, we own gold. I think everybody here isn't just in one commodity, and that's it. You're open to different ideas in different companies, even stages of development. At the end of the day, sometimes we see gold recently go up quite a bit more than the equities. And then it begs the question, why is that happening? And then it goes back to, okay, not enough buyers, not enough usually retail buyers are bidding up the stock price. So in the same way that we've been, I guess, suffering this issue in the mining industry, in the junior mining industry as a whole, uranium is not immune to that. So we see, the gold price go up, and then we look at the juniors, and I'm scratching my head going, wow, I thought this company was cheap, but now I think all of these other companies are cheap as well in comparison, if you believe that the price of gold and silver will hold up. And so because, we haven't, as an industry, attracted enough new investors to see explosive prices. And let's be honest, we're competing with crypto. We're competing with tech. We're competing with other investment theses that are maybe easier to understand, have a learning curve that is not as long and not as complicated as investing in what we do. And so we have to be honest about this and say, look, investing in mining is very niche, and we need new blood. We need younger people coming into here and thinking this is awesome and the price is going up and everybody's making money. And I think that the more that we talk about it, the more that we go to these events, and the more that we promote the mining industry as a whole, then the better we'll all be.
Mart, what about you? Because in that case, actually the uranium bull case is almost a bear case for a lot of the companies, because it's personnel issues. We see that from URG, we see it from virtually everyone. It's hard to get people who know how to do uranium mining. It's hard to keep them, because once you get them, you train them, they get poached for more money. That happens a lot. I know you own the equities. How do you deal with that?
I think it's very important to assist. I'm kicking in a massive open door here. Excuse me. But it's very important to do, of course, do your due diligence. But I want to touch upon one point in particular, what you mentioned with regards to a complete drought in skilled personnel. Because following the Fukushima Daiichi disaster that we've seen post, of which we saw the uranium prices crater a lot in the decade after that, what you've seen is that a lot of skilled personnel has left the industry. As I'm sure all of you know, mining is quite a difficult endeavor, and uranium mining is certainly no exception. And I recently spoke to the CEO of a uranium producer in the US, and he rightly noted, I asked him, outside of Cameco and Kazatomprom, the two big players, if you will, how many people are there that genuinely know how to build a uranium mine? And he looked me straight in the face and he was like, 8. 8 people, including himself. And that is a ridiculously low number. And I think that also has a big influence on the equilibrium price level that you need to incentivize enough production to get online. So Fabi already mentioned it a little bit. Paladin is one example. They recently revised down 1.1 million pounds. And they haven't really mined anything yet. They've just been processing above ground inventory. You have Boss Energy, which has a restart project in Australia called Honeymoon that has faced its own issues. They've been done well so far, but it's certainly not going without certain bumps in the road. So what we're seeing right now, looking forward, these companies that you mentioned, if you invest in them and you expect them to get into production anytime soon, I think a lot of people are going to be very surprised, because even at $100, $110, $120, where on paper all these projects should be making money hand over fist and should have capital lined up to finance them, they're simply not the people to do this. And at that point, I think that a lot of these fuel buyers, which have been so dependent on their spreadsheet and which have looked at supply-demand modeling, say, okay, I have a bunch of demand that I need to fill from 2029 onwards into 2035, for example. Okay, I'm looking at Arrow, the best, undoubtedly undeveloped uranium asset in the world, which, according to NextGen, they're going to put into production in 2029. A lot of these utilities and a lot of these people that are expecting this to be in production in 2029, I think are going to be very, very surprised. And if that happens, this is a 28.8 million pound a year mine for 11 years. If that is delayed by 1 or 2 years, that's going to cause the already exaggerated supply-demand imbalance to get even bigger. There are a bunch of other deposits that should get into production over the coming years. And there too, I think people are going to be either positively surprised, depending on the equities you invested in, or not so positively surprised if you have some uranium commitments that you need to fill. So I think that you need to circle back to your question, I think it's very important to really do some rigorous due diligence and know what you invest in. And if you don't have a lot of tolerance for risk and you're looking at this like, okay, the thesis is very solid, but I don't want any counterparty risk, the Sprott Physical Uranium Trust offers a great option. Some of the majors, including Cameco, offer options that are liquid. But in the end, I think the complete drought in intellectual capital will have a big impact on an already bad supply-demand imbalance. And to be fair, what we've seen over the past year, even with the majors, even with Kazatomprom, I think we're going to be in for a lot of surprises when it comes to the supply side over the coming years.
Judging by what's been happening in some of the other sectors, really what kicks off kind of a frenzy in junior mining specifically has been one of three things. So you have retail coming in, so kind of a retail frenzy pushing everything up. Maybe we get that on the back of spot going up. There's a delta between spot and term. There's also stuff happening in between that we don't necessarily have time to talk about today. The second part has been what Eric Sprott did in 2015, 2016, which I dare claim he almost single-handedly saved the junior, specifically precious metals junior miners, where he deployed over $1 billion, I believe. That created a lot of excitement as to, oh, okay, the big money is now finally flowing in, got a lot of other money in, and I think a lot of us remember the shortly lived, unfortunately, bull market of 2020 and 2021. And then the third one is, of course, big M&A following, which we also kind of have an issue with in uranium. Because who's going to do more M&A? I mean, we have this Fission Paladin deal, which has been lingering on for a while now. Where is that going? I don't know if anybody knows, but is Cameco going to do M&A? Do they have to? They have a bunch of land in the Athabasca Basin. They're the largest landholder in the Athabasca Basin. Do they have to go up and buy up the juniors? Sometimes they drill 60% of uranium. They wouldn't even do a news release on it. They just report it in their MD&A. Stuff like that. So which one of those things is actually going to happen that saves us? If we exclude the potential for a retail frenzy, like, are we going to see, and I don't even know if billionaires are that eccentric to start paying attention to uranium, but are we going to see billionaires coming in, or are we going to see more M&A?
It's a good question. I do see M&A happening more and more. Likely, if I could guess, in the smaller side of the sector, of smaller companies, especially in the US, because geologically it does not make sense for there to be as many small US uranium plays as there are now. There's small deposits, the grades aren't really that high. Some of them will become economic as the price goes up and stays up. And you know, the US is really one of the countries that is finally starting to become more and more pro-nuclear. China has been on that road for quite some time now, and now the US is trying to catch up and saying, hey, we need to double, actually scratch that, we need to triple our, you know, nuclear power grid. And as they do that, they're going to look at their domestic production and say, you know, like, this doesn't make much sense. there are a couple of players in the U.S. that could get, trigger happy. There's UEC that is known for, buying up different projects. Encore Energy is a big question mark. They did make some purchases back in the day. And so the M&A road that I see is more towards, this part. I was completely surprised by Paladin and Fission. Also, the ISO merger to me was a little bit of a surprise. And I'm not really sure that the Paladin deal is going to go through, to be completely honest. At this point, too many issues have arisen, and I don't think shareholders like that deal at this point. So let's wait and see how that works. But there's also the possibility that has actually historically happened before of outsiders coming into the sector. Unfortunately, we do not have our own Eric Sprott, I don't believe, and I don't think that Eric likes uranium. I think he's, a gold bug through and through. But you have historically the oil companies coming in and buying up nuclear. So, outsiders that wanted to expand their energy book, they went into uranium and they were able to buy a few assets. Also, very much US-based. Will that happen again? I have no idea. I don't have any, inclination to say I think this company is likely to do that or the other. I think the oil industry right now is going through their own issues and struggles, and so maybe tech coming in, and maybe we'll see new billionaires coming into this industry and bidding up the stock price. I don't see who we know currently in the mining industry coming in to say, rescue the uranium juniors. I just don't see it.
Maybe Mart's got a long-lost family member who's a billionaire. He's going to help us out. We have 3 more minutes. Let's take 3 questions from the audience for a minute answer each. Any questions about uranium? Go ahead. So the question was, I'll repeat it because I don't know if the recording is going to get it. They're asking, she's asking about Alpha Energy, I believe. What's the opinion there?
I think it's a very exciting exploration company. It certainly has a much bigger market cap than your average uranium company, but that's mostly because they have an enormous land package. In my office back home, I have a map of all the Athabasca Basin projects, and you just have this massive singular color of just AFA having staked a lot of land. They've already have some discoveries as well after also taking over 92 Energy, who made their own discovery. So I think that when it comes to exploration companies, that they are a lot more liquid, and I would say a little bit more safe than some of these earlier stage exploration plays. And their land package dictates that they will trade at a solid valuation compared to perhaps some of their smaller counterparts.
Yeah, I like their management team as well. Very serious people, very strong backers, which is important. And I like their Thelon Basin projects. I think they're going in quite heavy on that, and I'd like to see more of that being done.
John Mark Stoudy of Riverside Resources.
ISR, in situ, is very, very good and very helpful. However, there's a lot of concern now in many places about water and water tables. Do you think that environmentally, the concern of water and water tables is going to make it difficult for ISR, or do you think that ISR's projects are going to go ahead and that's not really going to impact? Because if it impacts, it'll really change the uranium market.
That's a great question.
I think I need to double my IQ to repeat all of that. But John Mark Stoudy is asking about ISR and water issues. ISR uses a lot of water. Environmentally, how's that going to work? Am I doing it justice?
No, but she'll answer it.
I got it. In short, yes, that is an issue that is going to be case by case. There are some places and some projects where that won't be an issue. It's really due to where the uranium is, the concentration, where the water table is, and how that's being done. In some places, they haven't had historically a problem with that. But it's something that I think even could raise questions from communities. Like, hey, how is this going to be done? I know it was a problem in Niger where the community was like, okay, we don't want this. I mean, they're in the desert as it is in many aspects. And so, yes, it is something that you should ask the management team of whatever company that you're looking at. Hey, if your project depends on ISR, what are the concerns regarding water, and is this a contamination issue? So,
Something that I would add as well, with regards to the other angle that makes ISR mining feasible, is the sulfuric acid that you need, specifically what we've seen in Kazakhstan, where the by far largest uranium miner in the world is facing their own sulfuric acid shortages, which means that the way that ISR mining works, you don't get the pounds out of the ground immediately as you put the sulfuric acid into it. It has a long lead time that then follows it. So if you miss your window and the ground freezes over, you're not going to get your uranium pounds the next time you were supposed to produce. So it's a very simple way to explain it. But what it basically comes down to is that they have not solved their sulfuric acid issues yet. They are well on the way to do so, but that's going to take a few more years. And with the largest uranium miner in the world facing their own ISR-related issues, I think that just adds to an already powerful uranium investment thesis.
Good. We're in Germany and already over time, which is a cardinal sin, so I'm going to have to wrap it up here. Kai, you want to come on up? Thank you. Mart and Fabi, thank you so much for today.
Thank you.
thank you. Thanks.
Fantastic.
Oops.
Thank you so much. That's great.
Thank you.
Mart, thank you. Thanks so much, Antonio.
I'll see you later.
Good job.